Canadians have an average of $20,000 in non-mortgage-related consumer debt. A recent survey by consulting and accounting firm BDO Canada found that nearly a quarter of Canadians are feeling overwhelmed by their debt. Consolidating that debt can help, but there are several ways to do this. Here's online reporter Erica Alini with this week's Money 123.
The concept of debt consolidation is pretty simple. You take out one big loan to pay off all or most of your smaller debts. Usually, debt consolidation has three advantages. First, one bigger loan means a single monthly debt payment. Second, you might be able to get a lower interest rate than what you were paying on your smaller loans. Third, your new monthly payment may also be lower than the sum of what you were paying before. This is usually because your interest rate is lower or your loan term is longer, or both. But how to consolidate debt is anything but straightforward. So I asked some experts to rank the most common options. The number one recommended option was term loans, also called personal loans. Data from financial products comparison site Rate Supermarket shows that term loans from banks and credit unions have interest rates of between 4.9% and 11.99%. This is higher than the interest you'd pay with other debt consolidation options, but still much lower than the 20% interest you pay on credit card debt. With a term loan, however, you have to repay the loan within a certain time frame, usually 1 to 5 years. Experts say this helps people stay on track and actually pay off their debts relatively quickly. The second option was lines of credit. The attractive thing about lines of credit is that they have low interest rates, between 5 and 8% for a so-called unsecured line of credit, where your debt isn't backed by an asset, and as low as 4.2% with a home equity line of credit, or HELOC.
Lines of credit have variable rates, which means they could go up or down. And when you pay as just the interest outstanding on the debt, it creates a psychological trap where you end up kicking the can down the road, so to speak, instead of actually reducing the total amount of the debt owed.
Mortgage refinancing is a third option and offers even lower interest rates, as low as 3.4%. The catch, though, is that you are potentially spreading your debt over 20 to 25 years. So while your monthly payments may become smaller, you may pay more in interest overall. A fourth option is a second mortgage, a loan backed by a house that is already mortgaged. Second mortgages have a higher interest rate than mortgages, and experts say they should be considered only as a last resort. Carrying two mortgages means having a lot of fixed costs, and if interest rates keep going up, those costs may climb at every mortgage renewal. And finally, experts say that asking family and friends to co-sign your debt consolidation loan is generally not a good idea. It can put a lot of strain on your personal relationships, and it also limits your co-signer ability to borrow, because when they apply for a loan, your debt is going to count as their debt. So if you can, try to keep family and friends out of it. This is Money 123 for this week. I'm Erica Alini.